So I think we'll make a start. Good morning, everyone. My name's Rakaya, and I'm the Digital Marketing Executive here at Gerald Edelman. In today's webinar, we're going to be covering Brexit and VAT 5 months on. Leading the session is going to be GE partner and VAT expert Richard Staunton, with the help of our VAT managers Joe Reed and Glenys Gibbs, who you can see at the top there. Just a few housekeeping notes. You will be on mute for the session, but at any time, if you have any questions, please just use the Q&A box at the bottom and we'll try and answer them all throughout or at the end of the session. And then after the session, we'll also be sending you the recording and the slides as well, but this will also be available on our YouTube channel. So without further ado, Richard, I will hand over to you.
Thanks very much, Kyle, and welcome everyone. Welcome to returning people, because I did do a Brexit update a few months ago. So welcome to those people. I hope you weren't too traumatized from the last one. Good to see that you want to come back again. And welcome to anyone new as well. And I hope you find this session useful. It's actually going to be threefold. The purpose of the session really is threefold. So the first section is going to be just going over some of the changes that have happened on the 1st of January. Just a nice, easy way in. It's a little bit more settled. HMRC are gradually introducing guidance and materials for us, but not but the word is gradual. But we're starting to get the hang of things, really. And some of the things that we thought might happen or might not happen, we kind of know a little bit more now. So I'll talk about that for the first third. The second section is a few examples about things that we've come across that are interesting to us. So they're not the boring stuff like, oh, I'm selling goods into the EU. What do I do? Because they'll be covered in the first slide. These are a couple of examples of interesting things where we've had to find solutions and unintended consequences of Brexit as well. So. A couple of interesting examples. And the third section, it kind of isn't really about Brexit, because the third section is about the changes in Europe that are happening on the 1st of July. They were supposed to come in on the 1st of January, but I think Germany and the Netherlands pushed it back helpfully to the 1st of July, which means we've had some sort of no man's land for the last 6 months. So these changes are coming in the 1st of July. So they apply to the single market. But of course, they apply to the UK, because if you want to trade in Europe, and the complication or the link to Brexit is really that the UK will be a non-union member now. So there's an extra stage or an extra complication for UK businesses. I'll talk about those slides a little bit more detail, obviously, when I get to them. But I think the key there is that actually we think that for a lot of supplies being made from the 1st of July, it might get a little bit simpler. It might get a little simpler than it is now. So those are the three things. Some of these slides have got hyperlinks that might be quite useful. So as Kai has said, there are ways and means of you getting these slides, but if you want any advice, you can always contact the VAT team or your usual GE contact. Let's get into the slides themselves. So that's the contents, recap position, practical examples, and e-commerce. So the last few months or so has been quite challenging from VAT, and especially customs and duty. And I think part of that reason is because everything was at quite short notice. So even though the vote was 2016, even though it was 2016, we didn't know what the agreement was going to look like until I think it was around Christmas Eve. And then, of course, there's a flurry of information coming out. And it was we had loads of unintended consequences, I think, that have trickled through from the 1st of January onwards, that we're going, oh my God, we didn't think about that. We didn't think about that. And I think partly that is because the agreement, for whatever reason, was made at the last last minute. And my final point on this slide, that politics aside, I think we have taken for granted how easy it's been to trade with the EU over the last 28 years. And I think we're finding that there are barriers in place, but none of those barriers are, you can't get over them somehow. You can't find a way through, even though there might be some additional costs. 2021 has been the biggest change in VAT that I've ever seen in my 30 odd years. It's not only the exit from the EU, but we've got something called a domestic reverse charge in the construction industry, which is a different way of invoicing or accounting VAT through supply chains in the construction industry. We've also got the changes that we're going to talk about from the 1st of July for some digital type supplies or supplies across the internet. And we've also got a load of changes for VAT caused by COVID. We've had reduced rates of VAT across the hospitality sector. We've had changes to paying VAT, not having to pay VAT last year on your VAT returns, and now that the economy and everything's starting to turn to normal, then actually time to pay requests and that sort of thing, getting all that back up, getting that money paid back. And also there's going to be new penalty regimes as well for late VAT returns as well. That was another one that it's a minor thing, but in a normal year it would be quite a big change. We will be quite excited about it, but now you sort of almost keep forgetting about it and have to remind yourself, oh God, there's just another change. I think that the biggest change that I've ever come across before this year was actually 1993. 1993 was when the UK entered the single market, 1st of January 1993. And actually, I got married 6 months after I got engaged about 2 or 3 weeks before we entered the single market, and I got married 6 months after we were in the single market. And I'm sure someone cleverer than me could think of a really funny analogy about that. I can't think of one, but my marriage has lasted almost as long as Great Britain's involvement in the single market. So that must be some sort of feather in my cap somewhere, I think. Okay, so if we go on to the first section, which is effectively just a recap of some of the rules. So supplier services, we'll start off easy, and I think really we're starting off easy, and then as the slides go on, they'll probably get a little bit more complicated. So supplier service to the EU, really not really dramatically different. So EC sales lists aren't required anymore for B2B because we're no longer in a single market. Digital supplies, Moss and Tom's, that's changed a little bit. Intangible services, which is the one that we probably get the most routine questions and the easy ones, that doesn't really change at all. In fact, it's become simpler because for intangible services, accountants, consultants, estate agents, you don't need to worry if your customer is a B2B or B2C. It's still outside the scope of UK VAT, so you can effectively, you don't charge VAT on it at all. So and you don't have to find the VAT number or prove that your customer's in business. Most services received from the EU would be effectively treated the same way. It's a reverse charge. The difference will be that the invoice from your EU supplier probably won't mention the reverse charge is due, because when you're in a single market, it's a legal requirement to put a notification on your invoice. We're no longer in the single market. And the same applies actually for UK into the EU. It probably is still a good idea to put reverse charge applies, but it's not a legal requirement anymore. You still include, from services received from the EU, you still include the VAT in box 1 and subject to normal rules. Box 4, the return. So generally, it's a nil net effect unless you make exempt supplies or you're in the finance sector or education or certain charitable supplies. So if you're buying for non-business, you generally won't be charged local VAT from an EU supplier from accountancy services. So it's kind of it would be the same. It's the same way round sort of thing as UK to EU, EU to UK. For businesses that incur EU VAT, the change to the EU refund system is quite dramatic. So there's quite a few changes going on there that you can no longer do it through the HMRC portal for VAT recovered in 2021 onwards. You have to do a paper return, and you have to do it in your local language. And that is actually a step back, probably 10 or 15 years. 10 or 15 years ago, that was what the system, and they brought in this new, lovely, simple system for us all to do in our local language. Now we're out of the single market. We go back in time, basically, and we have to complete paper forms. And there's some use. Actually, this is one of the examples, but some use and enjoyment rules on certain supplies that vary across the EU that we now need to be aware of, again, because we're no longer in the single market. And then there's a few services accepted, which are exceptions to normal rules. So Tom's is one of them. So the VAT notice, thankfully, has now been updated 31st of December. I think it actually was released a little bit of time after that, and that causes a bit of head scratching. I guess with COVID, it probably isn't really relevant at the moment as much. In a way, that's probably a good thing to come out of COVID. You don't have to worry about Tom's. Okay, you've got to look for a tiny little nugget, haven't you, somewhere? But for the margin applying to supplies in the EU will now be treated as zero rated. The margin for tools in the UK will be treated as standard rated. Temporary reducer, it doesn't apply to the margin. That's the COVID stuff. It doesn't apply to the margin. But to be honest, I don't think there's very many tour operators declaring a lot of VAT at the moment. I suspect that at some point the rules will change so that UK operators doing TOMs in Europe will have to register in Europe, because if at the moment they don't have to charge, they're zero rated on their margin, they're getting an unfair advantage compared to all the other member states. And I don't think the EU would allow that. It isn't fair. So I'm sure that there'll be something that something will change. But I guess at the moment, there probably isn't a great deal of rush over that. We're no longer in the mini one-stop shop, and you will get sick of one-stop shop at some point during this presentation, because the whole of the last third of the slides talks about one-stop shop. But the mini one-stop shop, we're no longer in the EU, so we'd have to do a non-union VAT MOS registration. But that's only from now to the 1st of July. And then after the 1st of July, the mini one-stop shop disappears and is replaced by the one-stop shop. This is something that's really only for financial services, so specified supply. So this is where if you make exempt supply, if you make supplies that would be exempt in the UK, and those supplies are deemed to be made outside of the EU prior to the 1st of January, you could recover your input tax. If your customer belonged in the UK, you'd be exempt. So if you were lending money to someone in the UK or arranging finance or selling shares, that sort of thing, then your VAT relating to those supplies would be blocked. And the same applied to if your customers were in Europe prior to the 1st of January. It would be treated like it was in the UK, effectively. That's now changed. So the EU is treated exactly the same way as non-EU. So you've got customers that are in the EU that you supply certain financial and insurance type services. You can recover VAT relating to those services from now on. And if you look at the final paragraph there, HMRC has confirmed that where costs were incurred before 1st of January, but they were relating to services made to EU customers on or after 1st of January this year, then the business can recover that VAT as fully deductible input tax, which is it's obvious, but it's actually really then underlines effectively this rule, and it gives, again, like Tom's, gives an unfair advantage. You could argue it gives an unfair advantage to UK financial services type businesses. So there may be something, probably when they're talking about the agreement on services later on in the year, there may be some tweak to this. But at the moment, financial services type businesses have got a little bit of a windfall. As I said, refunds of VAT in other countries, I think I said on an earlier slide, you no longer claim it through the portal, so it's a paper exercise. You have to get a VAT 66, which is a certificate of status, basically just showing that you're VAT registered in the UK to prove to your European, to the country where you're making a claim in Europe that you're actually registered. And you have to do it in the language of that country. So it becomes refunds in the EU become a lot more problematic as we go forward. And the retail export scheme for Great Britain, that's going as well. That's gone. So we no longer do that. That's tax-free shopping. So that's where a tourist from outside of what was the EU comes into the UK, buys goods. If you see the tax-free shopping on the windows, they can basically get the VAT back minus a bit of an admin charge. That's now gone as well for Great Britain, but not for Northern Ireland. It continues for Northern Ireland. Helpfully, HMRC have withdrawn the imports notice, which is probably the worst possible time they could withdraw it, but I'm sure it's because they're completely rewriting it. You need an EORI number. Hopefully, if you do need an EORI number, you'd have got that by now. Very straightforward to do it. It's a hyperlink there. There's something called postponed accounting that's now been introduced, which is really useful. Method of payment code G. You stick that on your import declaration, and that means you don't pay VAT up front. You just have to amend your VAT return, which is really good for cash flow, and it applies to both EU and non-EU imports. So that's quite a useful change. That change I don't really think has anything to do with Brexit. It was just a change, and it's happened across Europe as well. And there's also simplified declarations. We don't really recommend that because we just find that you're going to have to do the full declarations after 6 months anyway. So it's the fact that it makes more work for you. So we've never really recommended it. And the time's running out now anyway, but I thought I'd stick it in as stick it in the slide anyway. Oh. What happened there? Okay, so the duty deferment account, it might be useful to get a duty deferment account. We don't have to do Interstack declarations apart from imports up to 31st of December. And just bear in mind that grants are being offered and available for training and professional advice. That's quite useful. There's a lot of money out there if you need it. So it's worth accessing that if you possibly can. We say this time and time again, and it's worth repeating that you should appoint a customs agent to complete your export declarations and your import declarations if you possibly can. A lot of the problems that we see now, both in the press and with our clients, are people who haven't appointed an agent, or the agent isn't doing their job correctly, and that causes problems, especially with rules of origin type stuff. Which again, the hyperlink the bottom talks about proof of rules of origin, and that's where if you can't prove that your goods selling into Europe from the UK, if you can't prove that your goods originated in the UK or the EU, you will get charged duty when it crosses boundaries. So that's something to bear in mind. Goods into the EU, just keep the evidence and time limit supply. Actually, the change there is that it's B2B and B2C. So if you're selling to the end consumer, then you charge you charge a zero rate at the UK. But bear in mind that, and we'll come on to this later, but bear in mind that when the goods cross border into Europe, they're likely to get charged VAT when the goods cross into Europe. So that's a fundamental change actually from last year to this year. That it used to be that if you sold into a private consumer into the EU from the UK, you would charge UK VAT unless you did distance selling. You sold a lot, and then you might have to register there. Licensing requirements might change. We've dealt with plants and flowers and stuff, and some of the clients we've dealt with, and that's quite stringent. It's not really a VAT issue, but there are other problems, not just VAT. And Interstack declarations no longer need to be required for dispatches. And as I said, distance selling has ended. It's ending anyway, so it's ended early for us, but it's ending anyway on the 1st of July. And yeah, Northern Ireland is a complicated one anyway. And I think that if you are trading in Northern Ireland, or if you're passing goods through Northern Ireland, you should take advice, because it has got its own separate rules. Because Northern Ireland is remaining in the EU single market and the customs union, but at the same time, it's remaining part of the UK VAT system and customs territory. So it's kind of got its feet in both camps. And that sounds like a good thing, but it does mean that dealing with Northern Ireland has got its own separate set of rules, unfortunately. If you're a Northern Irish business, it's probably quite useful for you, because you can trade fairly seamlessly with the rest of the UK, but you can take advantage of simplifications like triangulation, retail export scheme, and the EU refund scheme, because Northern Ireland hasn't left a single market. So there'll be no customs checks or regulatory checks approved for exports into Great Britain. The second-hand margin scheme will apply for Northern Ireland into Great Britain, and it will also apply for supplies of goods into the EU as well. So there'll be no tariffs. Distance selling up to the 1st of July will still apply. Second-hand scheme will still apply. Of course, second-hand scheme doesn't apply from UK into the EU. And also, it doesn't apply for Great Britain into Northern Ireland, which is quite a weird one to think. So if you're selling a second-hand car from Great Britain into Northern Ireland, you can't account for that sale under the second-hand margin scheme, which is a bit strange. And Northern Ireland have got their own EORI number as well, so they've got an XI prefix that needs to be required for Northern Ireland into the other EU member states. Supplies of goods from the EU and to the EU will remain completely unchanged, so no tariffs. Distance selling again will apply up to 1st of July. But there is actually a free trade support service that HMRC offer, which is that if you deal with Northern Ireland, it is worth using clicking on that hyperlink and dealing with it. We don't know how long the protocol is going to remain in place, and what's going to change over the next 12 to 18 months or whatever. But at the moment, it's worth using this, because there are oddities in dealing with Northern Ireland that you just need to check. And as HMRC are effectively offering advice, it's worth taking it up. So services, Northern Ireland, that's really going to remain very, very similar. So services to Great Britain will still attract VAT. Services to the EU will follow, I say, the current rules as of 31st of January. So because, again, they're still in the single market. And there's no reverse charge for services from Great Britain, apart from the construction industry, DRC, which is a construction industry thing, which is the same across the whole of the UK. And a reverse charge will still apply to services from the EU to Northern Ireland. So let's go look at some practical examples. I remember when we did go into the European Union back in '93, triangulation was a thing. I was actually in Customs and Excise, as it was called back then. And we called triangulation strangulation, because we felt it was so complicated. But actually, it's quite simple, and it's something that we've missed. In fact, 2 of my 3 examples are about triangulation, just because it's such it's one that comes up again and again, and because the supply chain is so embedded, you kind of forget that you're using these simplifications, so forgetting how easy things were. So. Yeah, and interest that was a downside. That's right. That was the 2. That was the well, it was so to us that triangulation was an upside, but people just couldn't really get their heads around it for a few months. So anyway, triangulation. I'll explain what it is. So triangulation is where the goods, and so it's EU. So it's effectively just an EU thing. So the goods go from EU state A to EU state C, but actually the invoice trail goes from A to B to C. And the problem for VAT with this is that the goods from A to C can be zero rated by state A, because the goods move from one EU territory to another, and they can also quote a VAT number an EU VAT number who would do the reverse charge, which in this example is B. So A can zero rate the supply because goods move cross-border, and they know that B will do the reverse charge for them. And then when you're in the EU, B can zero rate their supply to C because C will account for VAT on their behalf because they've got an EU VAT number. Because they've only made one journey, but under the simplification, they're able to treat that as a reverse charge as well. And what that means for triangulation is that you don't have to register in any more countries than you were registered in before you do that supply. So that's what it's meant to do, avoid VAT registrations. But of course, it no longer applies to UK VAT numbers because the UK is no longer, or Great Britain is no longer in the single market. So in the case that we had, our goods were produced in a factory in Italy. Actually, they were food goods. And they were food goods. So the irony was that if Italy had the same VAT rates as we had, actually those food goods, there wouldn't have been an issue because they would have been zero rated. They're all Domio type pastes and that sort of thing, and pasta and that sort of thing, as you probably would expect in Italy, I suppose. But actually in Italy, there was a VAT rate, I think it was 5%, 5 to 7%, I think it was, depending on what products there were. There was a number of them. And funnily enough, this morning, they've asked me to quote on checking that all this has been done correctly for the first 4 months. So I'm going to have to look at this later on today, I suspect, or maybe early next week. Anyway, the goods were produced in a factory in Italy. They were shipped to EU customers. They were shipped to the UK, and they were shipped throughout the world by a manufacturer not connected to our client who had a factory in Italy. Our client was only registered in the UK. So the Italian manufacturer couldn't use the UK VAT number for the EU supply because the UK VAT number was no longer showing as a VAT number on VAR, is no longer in a single market, couldn't account for VAT on behalf of the Italian manufacturer. So it had to charge Italian VAT when it sent those goods to, in this example, the Hungarian customer. The UK company couldn't reclaim the VAT back unless the UK registers in Italy because there's Italian VAT. And if the UK doesn't have an Italian registration, they'd have to register in Hungary because that's where the place of supply moves to. And there's no threshold for registering in any EU country or the UK for a non-established taxable person. So that means you haven't got a base there. You just happen to supply goods or services. It means you have to register there. So if you registered in Hungary, the Italians would stop charging VAT as an intercommunity supply. Or if you registered in Italy, they would just charge Italian VAT and you could recover it on your VAT return. So what we did is that we went to a really good Italian, one that we use all the time, but a very useful Italian contact that we've got, an accountancy firm. But we found that VAT registrations could not be backdated. And I know I'd come across this before, and I hope the rules changed, and they haven't. So VAT registrations couldn't be backdated. And because they're a non-established taxable person, it was quite complicated and costly because we needed a fiscal representative as well. So it was a very costly exercise. In fact, the Italian accountant said, if I was you, I wouldn't register in Italy. Luckily, the client had customers throughout the world, and one of their customers was in Ireland. And most importantly, they could actually import into the Republic of Ireland as the importer of record and make a supply there. And because of that, we obtained a ruling from the Irish tax authorities that we could use triangulation for the rest of the EU. It wouldn't just be useful for our Irish sales, but we could use it for all sales across the EU. But we had to make domestic supplies in Ireland for that to happen. We got a ruling from the Republic of Ireland, which was fantastic because getting a ruling off HMRC is almost impossible in the UK. Actually, on that, South Africa, you can ask for a ruling and not tell them who you are. So you don't have to tell any names or detail. You have to give details to get the ruling, but you can do an anonymous type ruling, and they'll give you an answer, which, that would be fantastic if you're a South African VAT consultant, because you could get all sorts of answers. But it doesn't happen in the UK. Well, luckily in Ireland, they're in that kind of the middle house but they gave us the answer that we needed, and we required. It made it really simple, a lot simpler for our UK supplier. They didn't have to do a great deal apart from have an Irish VAT registration. And this is actually a common feature of the last few months, that while it seemed straightforward, there were other complications that we found that we wouldn't have considered before we left the EU. This is one actually I queried. This isn't one of mine. This is one of my one of my team who did this, and I actually queried this. I said, this doesn't make any sense at all. But it's true. So a UK marketing business paid for advertising electronic billboards in Spain for its customer, which is German, a German customer. The Spanish charged the UK Spanish VAT under their use of enjoyment rules. We said, well, this doesn't make any sense. But actually, they wouldn't have done it prior to 31st of December. But these rules kick in when you're supplying to a customer who's not in the single market. So it's a direct consequence of not being in the EU. Use of enjoyment rules is like, it's quite a useful thing, but basically it says, your place of supply is generally business to business, but under certain circumstances where the outcome would be contrary to what the legislation really wants, or what the general rule would be, they tax it in the country of consumption. So here they're saying, look, these electronic billboards, your customer might be in the intermediate supplier might be in the UK, your customer might be in Germany, but these billboards are flashing all over Spain, and so they're being used, and actually they're being used and enjoyed in Spain. So therefore, you've got to charge Spanish VAT. They can't actually register in Germany and get a German VAT number because they're making bead supplies to Germany, which is under the reverse charge mechanism. So they've got no liability or no right to register in Germany. We think that they can't register for VAT in Spain because they don't make any supplies there. They could potentially make a 13th directive claim. We think that's a claim that's under the new system, so the paper systems. You have to do it in Spanish. But in Spain, you need a fiscal representative, which would add a lot of cost. And also, each individual EU country has got their own rules about what you can claim back. And I'm not sure whether an electronic billboard type thing under the use and enjoyment rules can be claimed back. In fact, I think it's unlikely, because I wouldn't see the point then of having a use and enjoyment, a specific use and enjoyment rule in Spain to apply Spanish VAT, only then to be allowed to be claimed under the 13th directive, which is something 13th directive claim is generally available to most countries. It would seem to be, well, what's the point of having use and enjoyment rules if you can claim it back anyway? So consequently, Spanish VAT could be a cost. So it could be a cost. We're going to look into that probably in a bit more detail to see whether that particular one is actually covered or not. So I have my grave doubts about that. But I think in this case, the actual cost of doing the claim and the fiscal representative probably outweighs the amount of VAT that they're being charged under these billboards anyway. So it's probably going to be a loss. And we're going to return to triangulation again. So the next example is a different UK company who wanted to register in the EU to take advantage of triangulation for the movement of goods, which is something we've already talked about. The company works at various times all over the EU and already had a VAT registration in another country, but they also wanted to register in Ireland, where they made some supplies, but they didn't currently. At first, we thought that the triangulation for this would work, like the first one. For a UK person, it's much better to register, I think, in Ireland, just because of the proximity and shared language. But actually, when we registered, or when it was registered for VAT in the Republic of Ireland, it couldn't take advantage of the EU triangulation rules because its Irish VAT number was invalid on VISE. VISE is the EU system for checking the validity of EU numbers. And a reason for this, after a bit of head-scratching research, the reason for this is that it was a two-stage process in Ireland where you've got your Irish VAT number, but that's valid for domestic supplies. You then have to have evidence of intercommunity trade for you to have a VAT number that you can use for things like triangulation. So to go back to our first examples, as soon as they started importing into Ireland, that would be intercommunity trade. Then our Irish VAT number would be useful for triangulation, but not before. So they were only able to zero rate intercommunity supplies of goods using their VAT number in their Eastern European and not their Republic of Ireland VAT number, which was an unintended unknown complication. In addition, we found that the rules apply slightly differently across the EU. So Spain, they require a business, they require a premises that, I think they have a premises visit to ensure that it's a legitimate business. So they've got extra rules and they must be applied for every 12 months for this second authentication, but effectively of a VAT number for the purposes of EU trade. And this really complicates, this demonstrates how complicated some rules become, because beforehand, we hadn't considered any of this because the UK must have just allowed, once you had a VAT number in the UK, your VAT number had both status as a domestic VAT number, but it also had a kind of a VISE status. Now we've come out of Europe, we realise, oh, hold on, other European countries have got different rules that we're now having to sort of learn and try and get around somehow. Okay, so let's just take a pause of breath. I'll try to take a sip of coffee and we'll talk about e-commerce in our final segment. And we're doing all right for time. Okay, so e-commerce. Right, so the EU introducing new ways to account for VAT on sales to consumers. These slides only deal with business to consumer. Business to business effectively remains unchanged. We're going to quickly look at ways to deal with it prior to the 1st of July and options after this date. So if we look at the rules now, which are about to go, goods under £22 going into the EU don't extract any import VAT or duty, so that's happy days if that's all you do. If you supply between €22 and €150, it does attract VAT, but not duty. Goods over €150 attract both import duty and VAT. So it's kind of it's a sliding scale. Anything under €22, you're fine. 22 to 150, it's VAT. Anything over that could be duty as well. Of course, then you have to start thinking about rules of origin and that sort of thing. We advise to use online marketplaces because if you use an online marketplace like Amazon, then they account for the VAT and the duty on your supplies. Downside is that they probably take quite a bit of commission for doing that. But the online marketplace is the person who takes responsibility. If you're not selling on an online marketplace, then you can actually get the customer or the seller to pay import VAT and duty. And that can be organised with a courier. And again, that's where things have gone wrong in the past, that people haven't considered about selling prices and factoring in local VAT. Or the seller can register for VAT in every single member state and act as importer of record if they really enjoy doing VAT returns in 26 different countries. That would be an ideal option, I would have thought. So from the 1st of July, we've got two new simplifications, IOS and OS, and MOS is going. Clearly, they're in the same sort of family. They're one-stop shops. But IOS and OS are really very different from each other. MOS has been merged with OS, and MOS is almost like a forerunner. So MOS was the mini one-stop shop for digitally supplied type services. Again, digitally supplied services, a bit like the use and enjoyment in Spain, digitally supplied services to end consumers are deemed to take place where the consumer belongs. That was a rule that was brought in a few years ago. And MOS was a way of accounting for VAT on a VAT return to all the different member states. And that has been a success. It's something actually I agree with. I think that as a kind of a VAT purist, I like the idea of VAT being paid in the country where it's consumed. So actually, I quite like the idea behind MOS and OS. And the way that MOS, the way the MOS and OS work is that basically, you accounted for effectively on one return. So they sound similar, designed to make accounting simpler, but they are different systems and they are targeted at different businesses. Although a business could need to have to register for both, but they are targeted at two different types of things. One thing I have all common is that they're made to ensure VAT is paid to the member state on goods or services consumed by the final consumer, hence B2C. Not introduced yet. We've had a lot of problems, obviously, with Brexit. I think with OS and IOS, and I know this is being recorded, so it might come back and haunt me, but I think that this is actually going to be quite simple to introduce, not introduce. I don't know, that's not even a word. It's going to be quite simple to introduce because everyone is, number one, it's across the entire EU member states. So everyone knows about it. All couriers know about it. But most importantly, it's something that's been talked about. It's already been done with MOS, but it's something that's been talked about for months and months. Everyone knows what the rules are going to be. All the freight forwarders know. So I'm expecting this to be quite seamless. I also expect it to solve some of the supply problems arising from Brexit as well. Maybe I'm being a bit too optimistic there. I think it will. I think it will. So bad news first, from 1st of July, the €22 low value goods exemption is going to be abolished. So we do have to be concerned when we're selling goods under €22 from outside the EU. It's UK. We'll talk about UK, but it applies to everyone outside the EU. And for outside going into the EU, consignments over 150, they'll continue to be subject to VAT and possibly duty. And preferably with those ones, it might be worth going for the online marketplace. For goods under 150, not so for an online marketplace. There'll be effectively two ways of dealing with those type of sales. You don't have to worry about duty because duty doesn't apply for goods under €150. You can either declare the VAT through IOS, or you allow the VAT to be paid on importation either by your customer or making an arrangement through your import agent to pay VAT on their behalf. Because bearing in mind that when you sell the goods from UK into Europe, that would be a zero-rated supply. And so if you're charging £120 on goods prior, and they're standard rated prior to 1st of January, that to a European consumer, that 20 quid would have been handed over as output tax to HMRC. Post 31st of December, so 1st of January onwards, the whole £120 is a zero-rated supply, right? But before you start cracking open the champagne, what happens then is when the goods cross-border into Europe, the import VAT will be collected by the European states. That 20 quid will then disappear as an import charge up to 1st of July, but potentially from the 1st of July, you can do it under IOS. So IOS stands for Import One-Stop Shop. As I said, it goes from 1st of July. It only applies to consignments up to €150. You can register for IOS now, 1st of April, in any EU country. So you do have to register in any EU country. I would probably suggest Ireland or the Netherlands, probably the best two to register in. Not that just the one. English is their Irish English is their first language, and in Netherlands they're so close, and English is very much a second language, and they're both quite easy to deal with. Some countries like Italy, we found to be problematic, but we found it problematic. You do have to register for us in a country. when you get an iOS identification number, and that identification number is stuck on all your packages. So when the packages cross into the EU, the relevant country will see that those sales will be accounted for on the iOS return. And the iOS returns are filed monthly. Records need to be kept for 10 years. That would be declared the applicable rate of the country where the customer belongs through iOS. So what will happen is that VAT on imports won't be due, but what will happen is that the sale, you'll have a VAT registration, iOS registration in a particular country, then you'll make out all your sales across the entire EU, and through that portal, which is a bit like MOS, through that portal in that country, they will then divvy out the various VAT amounts due in each country. It really does sound like a very simple answer to what could be a complicated question. But of course, it hasn't actually started yet. So we have to see how it works in practice. But it sounds like it's going to be quite straightforward. Having said that, if you just do really occasional sales in the EU, it might be better not to register for iOS. Obviously, if your sales are over 150 euros, and that's consignment, that's not a product, that's a consignment. If your consignments are always over 150 euros, iOS isn't for you anyway. If your consignments are under 150 euros, but you only do 1 or 2 a year, I wouldn't register for iOS. And you probably have to make that clear to your customer if you want your customers to come back and have a decent experience. But it's something that looks actually looks quite interesting. And this is the most Brexit slide of the two of them, because we are now in this system because the UK is a non-union member. So goods coming from the UK are coming from outside the EU, which is what iOS is actually for. And then finally, this is the final bit we need to talk about, is the one-stop shop. And that is really a European thing. It's not a UK issue. So it's a simplification that they've made in the EU. So the UK was still in the EU. It would apply to all sales that the UK made within the EU, and it gets rid of something called distance selling. So distance selling is basically when you sold B2C from UK into the EU, say to France, you would charge UK VAT until you went over the threshold, and each European country could choose, I think it's between 35,000 and 100, one of those two amounts. Once you went over that in any one calendar year, you'd have to register in that country under distance selling thresholds. That's gone now, almost completely gone, being replaced by a much lower 10,000 euros, which I think applies to your total outside of your country where you're registered sales to other member states. You can treat that domestically. Once you go over that, you've got to account for it under the one-stop shop. So this applies to UK businesses that are registered in the EU because they're already required. So maybe they've got a warehouse in there and they've got stock in a warehouse and they sell that stock out of the warehouse. Say it's in Germany and they're accounted for German VAT or whatever. From the 1st of July, where they're sending to other EU countries, not account for those supplies subject to the 10,000 euro limit under OSS. So they will be basically doing, again, a bit like iOS, well, exactly the same as iOS really. They'll be doing a portal where they'll be reporting to the German authorities about these are the sales I've made in all these different countries, and then it then magically goes to all those countries and they get the money. Again, I do like this because it means that VAT is accounted for in the place of where the goods, in this case, are consumed. And actually, MOS has gone, but it's been subsumed by MOS. So MOS, the mini one-stop shop for digitally supplied services, is still there. You just report it through OS. So you report goods through OS and you report digitally supplied type services, apps and that sort of thing through OS. So if you sell goods, and OS returns are submitted quarterly. If you sell goods that are delivered directly to your customer under €50 from outside the EU, that's not OS, that's IOS. So it could be that if you're a UK business or European business, but primarily for us a UK business, it may be you have to register for both IOS and OS. So it could be, if you were unfortunate enough to do loads of different sales from different places in Europe, you could be registered locally in one EU country. You'd be registered for OS in that EU country because you made, in inverted commas, distant sales to a load of other EU customers. And finally, if you then delivered some goods directly to the customer from the UK, you'd also have to register, or potentially you'd have to register for IOS. Although what you might do actually is you might get those goods under €150 to be delivered to your German factory, then make the warehouse, and then make supplies from that German warehouse to Europe. That might be a more sensible solution. So, in summary, it's fair to say that leaving the EU has been quite complicated. I think it's worth repeating that a lot of the issues that we've come across have been caused by incorrect customs declarations, and so it's always good to make sure that those are being completed correctly. I think that the rules being brought in on the 1st of July make a lot of sense, and I think that this is the direction of travel, that we're going to be finding this a lot over the next few years, that if you're not registered already in Europe under one of these IOS or OS, you're probably going to have to be in the future, because all countries want their slice of VAT on VAT is a consumption tax. They want their VAT. So we'll be moving more towards accounting for VAT in the local countries, and that will probably extend to supplies that GE makes to European end consumers in the future. We'll probably have to have an OS return at some point, I would have thought, in the future. This is definitely the direction of travel, because it was starting with the treatment of electronically supplied services some years ago. And finally, don't want to worry everyone, but that's just be prepared for some domestic VAT to be changed subtly over the next few years. If I was a betting man, I would put money on something happening to energy saving materials, because we've got we're hosting the summit on climate change or whatever, and Boris is apparently quite big on this. We used to have a reduced rate for the installation of energy saving materials, but it wasn't compatible with the EU legislation, so they took infraction proceedings against us, and we had to drop most of it. It still sort of exists in rump form, but it's extraordinarily complicated. I think you have to be on benefits, or something has to happen, because it has to be reduced rates have to be targeted at a certain community, and you're not allowed to bring in zero rates. I suspect that now our out of year will be expanding the zero rate base for things that we want to encourage, like energy saving materials. So just be aware that might change in the future. Right, the time is 5 to 12. God, that hour's flown by. That's the end of my presentation. There's a get in touch. There's the get in touch email address, or you can email your normal contact or the VAT team. I think I'll hand back to Kaya.
Brilliant. Thank you, Richard. If anyone has any questions now, feel free to pop them into the chat box or into the Q&A, and we'll give it a couple of minutes in case anyone wants to ask anything. But if not, thank you for joining, and have a lovely day.